Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, markets this week felt unsettled. Not panicked, but jittery. Stocks slid, volatility picked up, and bond yields surged again. What exactly is going on out there?
Yes, unsettled is the right word. This week had that uncomfortable mix of noise, narrative, and genuine uncertainty. Let's start with Thursday's session in the US. It was an ugly day on Wall Street, but not a crisis. Equities were volatile, drifting lower through the day, with intraday moves larger than we've seen in months. The VIX, the so-called fear gauge, crept up to around 20. Not high, not alarming, but enough to remind us that complacency has left the room. Asia followed the US lower overnight. The Kospi, one of the star performers recently, dropped about 2%, and that set the tone globally. But underneath it all, the real story was in the bond market.
Yes, the bond market stole the show. What's driving this renewed spike in yields?
The bond market is grappling with one simple truth. There's nowhere to hide. Long-term Treasury yields pushed higher again. And what's worrying investors isn't the level, it's the direction. Every intraday spike adds a layer of tension. At the same time, markets are locked into this will they, won't they debate about the December Fed meeting. A month ago, rate cuts were priced at nearly 100% probability. 2 weeks ago, 65%. Now, around 50%. Fed officials aren't helping much. They're speaking often, but they're not saying anything definitive. And because we still don't have fresh employment or inflation data, markets are literally flying blind. Neil Kashkari, never shy on commentary, was the latest to say there's no urgency for a December cut. And that shift towards caution is weighing on everything from tech stocks to credit spreads.
And that pressure really showed up in the equities most loved, or hated, by retail investors.
Exactly. The hardest hit stocks were the ones retail investors have been piling into over the past few months. A Goldman Sachs basket of the most shorted stocks fell 5.5%, its worst single-day drop since April. But even that was outdone by Citigroup's index of retail favorites, which dropped a full 6%. This was a day where the crowded trades got hammered. No hiding places, no pockets of resilience. And that's when market participants start asking, is this just positioning, or is something shifting underneath the surface?
Let's shift to China for a moment. The data drip continues, but it hasn't exactly inspired confidence.
Yes, China's data this week came with a familiar tone. Okay, but not good enough. Retail sales were broadly in line, which was fine. The disappointment came from industrial production, sliding from 6.5% to 4.9% year-on-year. Fixed asset investment also contracted more than expected. Beijing has been quietly easing conditions with technical tweaks, liquidity injections, repo operations, targeted lending. But they're not going for the big bazooka. China is taking what I'd call the 5-year plan approach, not the 5-minute fix. It's patient, it's methodical, but for investors looking for a catalyst, it feels slow.
Let's talk politics, specifically the US. There's been a lot of noise around President Trump this week.
Yes, and normally we wouldn't delve into personal distractions. But this week's revelations from the Epstein files crossed a threshold when senior officials were reportedly summoned to the Situation Room. These things, they bleed into policymaking. And remember, Trump is laser-focused on the midterm elections. Last week was a blow to Republicans, and to Trump personally. Out of the 53 candidates he endorsed, not one prevailed. That kind of result sharpens political instincts. And we're now seeing the president reach for populist gestures, such as a proposed $2,000 handout to every taxpayer, a package costing about $350 billion. Conveniently, that's roughly the same amount the US is collecting from tariffs. And yes, we're also seeing renewed pressure on the Fed to cut rates. We're living through noisy times. The big question is whether the volume gets turned up another notch.
That's it for this week. Stay tuned for more insights next time.